today's talk's title, that's not a great English, but here we are. We're going to be talking about a nice and controversial topic about mortgages, but how people actually make decisions about them, the role of advice, and also the role of confusion. I don't know how many people here in today's talk have had the pleasure and the experience of trying to figure out a good mortgage, but I don't think anyone has ever come to me claiming that they had a positive experience. And we have a world-renowned expert actually talking us through this. Susan Thorp is here. And now, Susan, I do have an exact bio for you. I would like to get it right. So Susan is the Professor of Finance and the Associate Dean of Research at the University of Sydney, actually the business school to be specific. She researches consumer finance, focusing on retirement savings, and in this case also mortgages. She uses theoretical, empirical, and experimental techniques to test consumer responses to advice, disclosures, and overall choice architecture. And her research has been published in many leading international academic journals, including Management Science, and trust me, it's not easy to get into that one, and the Review of Finance and the Economic Journal, all incredibly difficult to get into, as I'm sure any academic on the call can attest to. And she has attracted over $4 million in public and industry funding. She's a member of the steering committee of the Mercer CFA Institute and Global Pensions Index, a member of the research committee of the OECD and the International Network on Finance Education, and a director of super consumers in Australia. That's quite the introduction. I think from there on, it's probably best if I now shut up. Susan, I let you take it away. Yeah. One quick heads up for today's talk. So Susan's talk essentially has two parts. The first part is a bit shorter, and then there's a second part. And it got mentioned that if you have questions about the first part, she will actually stop. We can do a Q&A then already, and then we move on to the second part. So feel free to already drop some questions in the chat as we immediately kick off. And I hope that sounds good to everyone. We are recording, as always. Susan, feel free to share your screen and kick us off.
Thanks so much, Mel. At the time I sent Mel my bio, all of those things were true. Since that time, I have stepped down from being Associate Dean Research and gone back to being a full-time professor, which is very nice for research work and good for me. So look, thanks so much for coming, everyone. I'm really interested to hear your thoughts about the material that I'm presenting today. Because it had an academic purpose, but I think it also has some practical implications. And getting clarifications from across the board, views across the board are really, really helpful. And also helpful because at least the second part of this presentation is very much an ongoing project, and more feedback on the direction we should head would be super useful for our research team. So I'm going to start with a paper that's actually been published recently in a new journal called the Journal of Financial Literacy and Wellbeing. And it's joint work with colleagues in a project that has been funded by the Australian Research Council to study confusion in consumer financial decision-making with a special interest in mortgages. So this is just a headline, a bit of brazen self-promotion of our recently published paper. One of the reasons I show this to you is because some of you yourselves might be interested in submitting to this new journal, which has been initiated by Anna Maria Lissardi. And those of you who are familiar with the financial literacy research will be very familiar with Anna Maria. And the good thing about this journal is that it's open access. So if you're interested in reading the longer version of the research underlying what I'm about to show you a very short version of, you can easily access it through this journal. Now, it's no surprise to anybody in the room to say that residential property loans are financially important. Other than human capital, housing assets are the biggest contributor to household balance sheets, both on the asset side and the liability side via mortgages. So around 65 to 70% is the rate of home ownership in most of the Anglosphere countries and higher in many developing countries, interestingly. Residential property is about 40% of the asset share, and mortgage is about 70% of the debt share in US and Canada, and about 50% of the debt share in Australia. Now, it's also true that not only is it important to the stock side of the balance sheet, to the asset and liability side, but mortgages are really important to income flows as well. And the OECD estimates that about 15% of disposable income is the median commitment made by owner-occupiers across the OECD. And of course, in Australia, that can be much higher. You're probably aware that the Reserve Bank recently estimated that minimum debt servicing ratios above 30% of gross income are likely to be being met by about a quarter of borrowers in the Australian market by the end of this year. Not only are mortgages important, the mortgage market is incredibly complex. And if we surveyed the Australian offerings, we'd get more than 4,000 different contracts being available and about 140 potential lenders. Not only are there lots of products to choose from, but the products themselves have many different attributes. And that's the side of the mortgage decision that I intend to focus on in the second part of the talk. So the attributes, as you know, various interest rate structures, typically variable, but often with fixed components. There are still interest only or principal and interest loans. Different settings for equity redraw, portability, all sorts of ancillary features and bundled products, which are often sold to different people in the market. So we have a very complex market, a market where there are a lot of products to choose from and where the products themselves have a lot of different attributes, some of which can be quite hard to understand. So it's no surprise that when the ACCC surveyed borrowers in Australia, nearly half of them said that they weren't particularly confident that they'd made the best mortgage choice. As you know, during the pandemic, Australia, like many other countries, experienced very rapid growth in residential property prices. But since that time, we have seen significant falls in property prices across the board. And one of the areas that first home buyers can get into difficulty with is managing the repayment schedule as interest rates start to rise. And The Guardian published an article in February this year that again emphasised the fact that about a quarter of households were likely to be entering mortgage stress sometime over the course of this year. One of the things that I'm going to focus on in the work that we did in the first paper I'm going to talk about really relates to this calculator, which some of you would recognise from the ASIC Money Smart site. We're not going to actually work with the calculator in this particular study, but we are interested in the way people perceive the repayments associated with a mortgage relative to the way they perceive the lump sum amount that they're borrowing. Now, no criticism of ASIC intended, but if you looked at this particular mortgage calculator, I think you'd agree with me that the emphasis is on the repayments. Rather than necessarily being on the lump sum loan that the households are taking out. There's research in other areas of behavioural finance that look at this comparison between lump sums of money and equivalent repayment or annuity equivalent streams, so a stock and flow comparison, and looking at whether they are psychologically the same. So that's one of the questions we're going to address in this study. The research question that we're interested in primarily here in this first study, drawing on work that's actually been done in several other areas prior to the paper that we're working on here, does framing, that is showing the equivalent monthly repayment as a lump sum or vice versa, does that framing actually affect borrowers' comfort with mortgage debt? That's the primary question that we're interested in here. And the second question is, do mortgage brokers affect borrowers' comfort with mortgage debt, and what influence might they have on the lump sum framing effect? So the interest here is in this question about the psychological equivalence of things that are mathematically or financially equivalent, and then how mortgage brokers might play into that discussion, given their importance to the mortgage market in Australia and in many countries around the world. So I'm going to give you a really brief summary of part of the work that's covered in this paper, but I think you'll get the idea pretty quickly. So what you can see on this screen in the bottom half of the screen is a choice task that we administered to about 1,000 past, current or intending home loan borrowers from Australia, a reasonably representative sample of the types of people that would be borrowing to pay for a home loan. And we over the course of 10 choices, and this was all randomized in the ways that you would expect, we asked people to perceive comfort with a given amount of debt over 10 different levels, and the 10 mortgage debt levels range from 200,000 to nearly 3 million. The numbers are a bit odd because what we wanted to do was have equally spaced amounts on a log scale for the purposes of modelling later on. Now, these were framed as lump sum or mortgage payments in a within and between subject variations. So everybody that entered the experiment answered a set of questions about lump sums and then monthly repayments, or the reverse. And we also randomized over whether they saw these amounts in an increasing frame or a decreasing frame. Turns out both of those, the latter of those two things also turns out to be important. So if you look at the bottom here, if you look at the bottom of the slide here, you can see the choice tasks that people were given. Suppose you're buying a new house, you're taking a residential mortgage, it's the only one you have. The loan's got to be fully repaid over 25 years. 20% deposit has already been paid. So we're intentionally, I mean, people could infer it, but we're not really focusing on the particular value of the home or its likely future value or income, other things that would definitely be relevant to the decision. We're just focusing on these particular aspects of the decision. And then we show total debt amounts for this mortgage, and we ask people to indicate just how comfortable they would be with the given total mortgage debt. And then we start off at 200,000 and we move them through 10 choices to 3 million, or we start at 3 million and move them through 10 choices to 200,000. And then we ask for feedback on a 7-point scale. Now, the next slide shows the reverse frame, and you can see that it's very similar, except instead of offering people a choice about a comfort level decision about the actual lump sum debt, we're asking them about their comfort with the equivalent repayment stream. So there is underlying this a mortgage rate that was applicable at the time. At the time we did this study, it was around 3%. The actual mortgage rate is not all that relevant. The equivalence of the lump sums and the repayment streams over the course of the experiment matter here. So just, I'm not going to go through lots of analysis here. I'm just going to give you a really big picture on what we found. We found that higher average comfort with we found that people in the experiment express higher average comfort with monthly repayments than with equivalent lump sums. Now, this result didn't surprise us, given what we'd seen from other areas of literature that hadn't actually tested mortgage debt, but had been applied in other types of financial decisions. So a few years ago, Dan Goldstein and co-authors published some work that compared retirement annuity streams with equivalent retirement lump sums of wealth. And the lump sum of wealth, in that experiment, the lump sum of wealth at retirement was also be perceived as psychologically larger than the equivalent annuity stream. And we find psychological largeness here as well, in the sense that the debt looks larger and people feel more uncomfortable with the debt than they do with the equivalent repayment stream. So here, this component that's testing framing shows that people are significantly more comfortable with repayments than they are with a lump sum debt. Now, I'm going to make some comments about some of these other features of people in the experiment next. So we also found that, that people expressed higher average comfort with a mortgage debt when they were planning to consult or after having consulted a broker. So this first block here compares the comfort levels that people expressed when they had not used a mortgage broker compared with the comfort levels that people expressed when they had used a mortgage broker. So as you can see, the difference here becomes negative. So those who have not used a mortgage broker are less comfortable with large debts than those who have. And that's actually true of people who intend to use a mortgage broker. So these are people who haven't yet consulted a broker but express an intention or no intention to consult a broker. And you can see again here that those who do not intend to use a mortgage broker express lower comfort with larger amounts of debt, and those who do intend to use a mortgage broker in the future express higher comforts with larger amounts of debt. So when we look at financial literacy and numeracy, we actually find the reverse effect. So people that are higher on financial literacy or numeracy in this experiment are less comfortable with large debts. Same for numeracy, and we test these in a multiple regression setting as well. Now, I'm going to show you some econometric results here, but there's really only, it looks complicated. There are two things to see. Our goal here is to control for the fact that for most people, choosing to use a broker is likely to be related to their comfort with debt. So we're trying to control for selection into broker usage when we do the econometric modelling. And when we try to control for selection, and I won't go into the details of how we go about doing that at this stage, we actually find that the results stand up. So borrowers do in fact appear to make, brokers do in fact appear to make borrowers more comfortable with mortgage debt, and our lump sum effect doesn't go away. So the framing effect is robust to controlling for the selection into broker usage as well. We also show that the framing effect is less for financially literate people and broker usage. So being financially literate not only means that you are in general less comfortable with mortgage debt, but you're also less susceptible to perceiving the lump sum and the repayment stream as different psychologically when they are in fact mathematically the same. But brokers also appear to have this effect. So people who consult brokers are more comfortable with debt in general, but they also appear better calibrated. So their understanding of the connection between repayment streams and equivalent mortgage debt is also similar, rather than being susceptible to the framing effect. So just to sum up this study, and I'll pause here and see whether anybody wants to make some comments after this, the next couple of slides. One, I haven't explained all the results from this paper, but we do show using these experiments that we find that borrowers are less comfortable with lump sums than they are with repayment streams, which is consistent, as I said, with research in other areas, in other contexts, that shows that lump sums appear to be psychologically large. But there is a bit of a tension around this, because I think you'd agree with me when you look at mortgage calculators and the way that they are presented. It's not as if lump sum information is not presented. Indeed, it is. But most of them start with the repayment component rather than emphasising the actual lump sum debt component to start with, at least. We also show that financially literate borrowers are generally less comfortable with mortgage debt in general and less influenced by framing. And we find some evidence that mortgage brokers both make people more comfortable with mortgage debt and also, again, less influenced by the particular frame in which these debts are presented. We did some additional work that I haven't discussed so far that also shows that people that consult brokers are willing to increase debt more than those who haven't consulted brokers. And there's also some work in the background that we do that is presented in the paper that shows that people who are likely to go to brokers are those who perceive a higher level of house price risk. So people that are afraid about changes in house prices in one direction or another are more likely to select into broker use. And again, this is consistent with some earlier academic theory that one of the things that financial advisors like brokers offer is basically comfort for people who are anxious about taking risk. So I'll just pause there for a minute and stop sharing for a second, see whether anybody wants to ask any questions or make any comments. Okay.
Guys, feel free to just unmute and ask your questions, or drop them in the chat and I'll read them out. But in general,
Otherwise,
I thought that was pretty
I'll
clear.
just keep on. Okay, there's a lot of muted screens. Does the borrower's age also become a factor? Borrower's age matters to who selects into going to a broker. So younger people are more likely to choose a broker, and that's really unsurprising given that there's a trend to increasing broker use over time. And borrower age also feeds into financial literacy. So younger people tend to be more numerate than older people, but less financially literate than older people. So experience matters in this decision-making world, but that's not to say that all older people make better decisions than all younger people. That's certainly not true. Expectations around interest rates may have played a role. Yeah, so in this particular setting, yes, people who have expectations around changes in interest rates, and they do diverge. We did collect data on people's interest rate perceptions, but we found that it wasn't relevant when we included information about their house price expectations. So we had to make a statistical choice about which of those we'd include in the modelling. And the two bits of information were so highly correlated and the house price risk information was more informative. So we went with using house price risk in most of the modelling work that we do. The time that it becomes relevant is in relation to broker use. So people that are perceiving risk are more likely to select into broker use. Yeah. There's another question about using a mortgage broker definitely made people more comfortable when applying for a mortgage. Yeah, and when we ask people, and there have been other studies, we haven't done this ourselves, but you're probably aware of the fact that other people have done a lot of work on testing people's satisfaction with using mortgage brokers, and it's overwhelmingly positive. We find this to be true of financial advice in general. So people that take personal financial advice from a mortgage broker or from a financial planner, it establishes a level of trust that is really almost completely unrelated to the quality of the service it's delivered, sadly. But that's true in a lot of advice settings. Okay, I don't think there are any more questions in the chat, so I'll just go back to the next part of the presentation. So what I'm going to move on to now is some further work that was done as part of this project that really looks about confusion about particular mortgage attributes. And this work is really interesting in the sense that it isolates certain attributes that people focus on and others that they downweight. And it's somewhat surprising as to which ones that's true of. So earlier, at the end of last year, Lucy Dean wrote a paper about first home buyers losing money that was published in the AFR, and it had a table about home values in the capital cities, and I've taken the Sydney extract out of this, and it shows unsurprisingly that that if you purchased your house at sort of the COVID peak of the market in late 2021 or early 2022, by the time you reach the end of, well, the forecast was that by the time you reach the end of 2023, you could be looking at a 7% decline in the equity that you are holding in that house. And even by the end of 2022, equity at purchase had declined. Say you took it out at a 10% deposit, then by the time you reach December 2022, you'd be down to only about 1% of equity. Now, I know that a lot of people don't take loans at 10% equity, but it's not that uncommon. And we probably all see advertisements for mortgages at even lower rates of LVR. So one of the interesting things that emerges in this research that I'm about to show you is that the borrowers that we survey rate the loan to value ratio, which is obviously relevant to the problem that Lucy Dean's talking about in this article. people rate that as the most confusing and one of the most unimportant mortgage attributes. And I'm going to talk about the relationship between confusion and importance in a minute, but just hold that thought as we go through this piece of work, because it turns out to be quite important. So given the amount of confusion around mortgages and how many offerings there are, let's just backtrack a little bit and take a bit of a look at broker use in Australia. So new mortgages from brokers, it's really hard to get hard data, and I've seen estimates that sort of run from about 55% to about 65% of new mortgages. But we're not alone. About 71% of new mortgages are brokered in the UK, about 33% in the US, and about 70% in Canada. So the use of mortgage brokers is pretty common across Anglosphere countries. And we know both from experience and from reading the research that brokers can serve a really useful purpose in educating their clients, reducing search costs, and helping people go through the mortgage process. There's no doubt that they can help inexperienced borrowers with the complications of purchasing a home. And as I said before, they generate a really remarkably high level of satisfaction among their clientele. But on the other hand, they also have been shown to tend to recommend more expensive and high fee products, not only in Australia, but also in other countries. They tend to recommend larger, longer, and more levered loans. And there's a fair bit of data that suggests that broker fee structures are really unclear to borrowers. So we need to take note of the fact that they're linked to higher default rates. In this research, we're looking at which common mortgage attributes borrowers find confusing and important, and how confusion about attributes relate to brokers, whether they educate clients. We're also interested in trying to understand how broker use relates to borrowers' willingness to pay for common mortgage attributes. Can you just excuse me for 1 second? I'm working in my daughter's study, and I thought I had my computer plugged into the power, but it appears that I have not. So I'm just going to take a minute to plug my computer into the power so that we don't lose it altogether. So hold on a sec. Merle, feel free to ask questions if you want to, or take questions if you want to. I'll just get this core business sorted out.
All right, guys, any questions whilst technological difficulties are being dealt with? I do love having these blurry backgrounds on, because as soon as you're no longer the focus of the camera, you just completely disappear from the screen. You could be anywhere.
Yeah, that's so. Let me try again. Sorry about this. I really didn't anticipate this particular problem.
No, you're fine. You're fine.
Yeah.
So just to check, what exactly has happened?
I just need to reshare the screen because I had to unplug my machine and plug it into the power. And I'm just trying to get my mouse back again. Sorry about this.
No, you're fine.
Okay. Right. I'll try sharing the screen again. Okay. How's that? Can you see that?
Yeah, I can see you. We're all good to go.
Okay.
Up again with research questions.
Okay. So third research question was how broker use related to borrowers' willingness to pay for common mortgage attributes. Okay, so this is the description of what we did. We took an online sample of nearly 2,000 mortgage borrowers. Again, these were past, current and intended future mortgage borrowers. We wanted to get that cross-section for various reasons related to the research questions. They were 25 to 65-year-olds, and we made sure that the household income was above $45,000 per annum as a minimum level to be potentially into the mortgage market. And we fielded the survey in Australia in 2019. So in this task, we asked people, first of all, to learn about 13 common mortgage attributes. So features that you would all be familiar with. I'm not going to go through each of them. They're what you would expect. And then we asked them to do what's called a best worst task. So we showed them 4 of these attributes at a time, and we asked them to tell us which is the most and which is the least confusing attribute from the set of 4. And after gathering that information and combining it, this gave us a relative ranking across the aggregate, across aggregate groups within the sample of which mortgage attributes were the least important and which were the most important. We then asked them to undertake a valuation task where they had to choose their most preferred and least preferred mortgage from a set of 3 options that had 7 attributes. So more simplified mortgages with 7 attributes, and then asked them to make a choice task, choosing the most and least appealing mortgage. And then we undertook some econometric analysis that gave us valuations of people's preferences about different attributes. Okay, now just to summarize the findings in case we don't get to the end, what we find here is that broker use again matters to borrowers' perceptions and valuations of mortgage attributes. So we first of all show that borrowers assign less importance to attributes that they find more confusing, which we're concerned can relate to misperceptions and misvaluations. We also find that brokers influence variation in attribute confusion in interesting ways. So I'll show you this in a minute, but people's confusion, relative confusion about different mortgage attributes was less when they had consulted a broker. But we also show that broker users are willing to pay more for attributes that raise the volume and length of loan, and in that way also raise broker fees. So we find evidence in this study, both for an educational function for brokers or apparent, we've got a bit more work to do on that, and also for agency problems. So this is the first task that people undertook. They had to describe to us which mortgage attributes they found confusing and which ones important. They saw a choice task like this one. So there were 13 of these, and they did it for confusion and then importance, or in the reverse order. And they were asked over a set of 13, they made choices over groups of 4. So you can see that this one is about, for example, you could get a home loan package. Your mortgage term, how important or confusing was that? What about an offset account? Do you know what that is? Establishment fees, do you understand those? Do you find them confusing or important? And during the experiment, not only have we described these prior to undertaking this task, but if they were a bit forgetful or they wanted to recall what these things mean, if they hovered a mouse over any of them, then a little pop-up bubble would come up with some more with the same information about the particular attribute. So we weren't trying to test people's memories. What we were trying to do was genuinely measure how confused they were about these mortgage attributes. Now, if you have a look on this graph, what you can see bar charts that show the relative importance of attributes and the relative confusingness of attributes. The relative confusingness is shown by the orange lines, and the relative importance is shown by the striped bars. If it's a negative, if the bar is on the negative side, that's less important. If the bar is on the positive, that's less confusing. If the bar is on the positive side, that's more confusing. So you can see here that the loan to value ratio is regarded as the most confusing attribute out of the 13 attributes that people rated, but it's also counted as one of the least important attributes. And then when it comes to the most important, it's unsurprising that, that interest rates are treated as the most important attribute. They're also relatively less confusing. But you can see a bit of eyeball regression will tell you that confusion and importance are generally negatively correlated. So the more confusing I find something, the less importance I tend to assign to it. And for something like the loan to valuation ratio, as we know, that could potentially get people into a lot of hot water. So consumers are downweighting the importance of confusing features. We're going to go on and show a little bit of valuation about that later. We also predicted from the data set the characteristics of people who were likely to have used a mortgage broker. Now, they tend to be people with relatively low risk aversion, relatively low financial literacy and numeracy. They're more likely to have made a decision about a mortgage in the past. They're much less likely to be older. They're likely to be more educated, have a higher income, have some experience of significant financial difficulties in the past, and surprisingly enough, to be somewhat patient. So what we're looking at here is a picture of people who've got the resources to engage a mortgage broker, also who tend to be a bit younger, but maybe a bit low on the skill set side. So not so financially literate. Now, it turns out that the group of people who had consulted brokers expressed fairly similar patterns of confusion and importance as the people that have not consulted brokers, except for one significant difference. They tend to, the relative confusion and importance that they assign between attributes is less variable. In other words, the things that I find confusing if I've been to a broker, I find a bit less relatively confusing than the things that I find less confusing than more confusing. So my confusion ratings are sort of flattened, and similarly with my importance ratings. This could be consistent with brokers helping people to move through the possible attributes of a mortgage contract and giving them some understanding of some of the ones that they don't understand quite so well. So the results from that first task showed us that confusing attributes that tend to be rated as relatively unimportant, and brokers seem to have an influence over the way people think about this. The most confusing attribute in this survey was rated to be the loan to valuation ratio. And as we know, that's a critical factor in mortgage stress. And if you misjudge choices about that, that can limit your refinancing options and possibly change your chances of foreclosure. In addition, this inverse correlation is consistent across different attributes, and brokers reduce the differences in relative confusion attribute. And this is a result that we also verify using IV methods. So this is prima facie evidence that brokers are helping clients learn about attributes. We're actually undertaking a bit more research on this project to test that hypothesis a bit more thoroughly. So then I really want to move on very quickly to talk about attribute valuations. So one of the next tasks that we gave people to do was to choose a mortgage from a set of 3. We asked them to choose the one that they're most likely to choose and the one that they're least likely to choose. And they all had the same, they had basically the same 7 attributes, but at different, they were allowed to vary by their different levels. So you can see in this particular choice task that the interest rate varies between 5%, 3.5%. etc. And there are different setups around the type of interest rate arrangement that's underway. Again, people had the option to remind themselves of what these attributes were as they went through the task, and they varied over a certain fixed number of levels. So what we do with the data that we get from that task is a little bit of slightly complex econometrics. So I'm going to run through this for those of you in the room who are interested in it. Those of you who are not, just look away for a minute, because what I'm going to show you next is relatively easy to understand. So what we were interested in doing is looking at people's preferences for specific attributes. So what's my preference for a low establishment fee as compared with a low interest rate, for example? And in order to do that, what we did was estimate what's called a hierarchical mixed logic model in willingness to pay space. Sounds complicated, but what it means intuitively is that we valued everyone's preference in terms of interest rate points. So we set the econometrics up so that all of the preference parameters could be interpreted as interest rate points. So that allowed us to have this really nice way of comparing preferences between these different attributes. And then we further went on to estimate the effect of individual characteristic on these preferences. So we were able to distinguish between preference parameters depending on people's risk aversion, their financial literacy and numeracy, whether they were a household decision maker, and whether they'd attended a mortgage broker or not. So preferences were dependent on those characteristics, and they were measured in terms of interest rate points. So this gave us a good way of comparing them. I'm going to skip this slide because it just basically says that people have preferences that are what you'd expect. Now, in this box, I'm going to talk to you about how we measure preferences, and you can think of it in basically in two different ways. So if you look at this first column here, you can see average willingness to pay for using a major lender, for taking your loan from a major lender, from one of the big four banks, as compared with a foreign bank or a credit union. So there were the alternative ways that you could do it. And people were willing to pay here 0.197 interest rate points to choose a major lender rather than the alternative baseline level. Now, in order to sort of give that a bit more purchase, what we did was calculate that preference, those interest rate point preferences in terms of the net present value effect on some benchmark mortgage. If you have a look down the bottom of the slide, what we did was assume that take a 20-year, $500,000 mortgage and assume that over the course of the loan, interest rates were fixed at 3.5% per annum. So using that benchmark and this interest rate point adjustment, so we adjusted the 3.5% interest rate by the 0.197 points here, we calculated that this means that people would be prepared to pay $8,629 at the initial point of the mortgage on this benchmark mortgage for choosing to use a big four bank rather than a different type of lender. And then if you look if you look at this one, this is a really striking result. And don't get confused by the scale here, because remember that we're making a lot of assumptions about values. But one thing that people particularly hated was upfront fees. We actually find this result in other places in financial research, for example, in insurance choices, this massive and overweighted distaste for upfront fees. And people were prepared to take a hit of $43,000 on our valuation basis to avoid an additional $1,000 in fee. In addition, extra repayments were highly valuable. So if you were offered extra repayments as part of your mortgage package, then you might be willing to pay around $57,000 in net present value terms at the beginning of a 20-year loan for the benefit of being able to pay it out, to make extra repayments and draw those down sooner. Now, I won't go on to talk about financial literacy because we're getting low on time, but I do want to draw your attention to the same measurements when we compare people who won't use brokers with people who will use brokers. And the important things to see here are that in terms of preference differences between those two groups, we see that there's a stronger preference among broker users for things that also raise fees for brokers. So broker users are prepared to non-broker users prefer principal and interest repayments to interest-only repayments. Non-broker users prefer the ability to make extra repayments and potentially shorten the term of the loan, and they dislike longer terms. So if you want to, these are the valuations that non-broker users are assigning to these particular mortgage features. Broker users are willing to take longer term loans. They're willing to not pay for the ability to pay the loan out early, and they're more willing to accept interest only rather than principal interest loans. So just to stop here, I'll just wind up with the results from that very last experiment. What we find is that broker advised clients favour attributes that can raise fees. People in general express high willingness to pay for some relatively unimportant attributes. which is consistent with our confusion and important results. Broker advised participants in the experiment are willing to pay less to reduce loan terms. They're willing to pay less to have principal and interest rather than interest-only loans, and they're willing to pay less to opt for an early repayment, all of which would be consistent with extending trail commissions. And we also find, I didn't show you these results, but we do find that highly financially literate participants are willing to pay more for principal and interest relative to interest-only repayments, and they like the option on early repayment. Okay, so I'll stop there and open the discussion up again if anyone would like to make some comments. So Monica's written in the chat, do you suppose that the loan to value ratio is rated so confusing because it's a ratio? A concept that's often perceived as mathematically more confusing than equivalent expressions. That could well be the case. One thing that we could do to test that is to compare the numeracy of people who rated loan to valuation ratios as confusing with those who rated them as less confusing. So that's something we should probably follow up. Thanks for that suggestion. Yeah.
Susan, was there anything around the comprehension of the service that brokers provide? Because brokers kind of position it as, hey, this is a free service, but obviously you're showing in a previous slide that there's a higher fee and everything like that. Did you delve into that at all, if people understood that there's a hidden cost?
That's something we're going to do more work on in the next round of surveys, Aaron, because I think it's really important. So other people's work and some of the industry reports show that people really don't understand the way that brokers are remunerated. And indeed, there's one of our research team has recently taken a mortgage, and he shared with us the information about, he engaged a mortgage broker, and he shared with us the information that he was given about mortgage broker fees at the time he took the loan out. And firstly, the information was only given to him actually by the lender, which turned out to be one of the big four banks, after the loan was finalised. So there was no sort of, prior to the finalisation of the loan, he didn't really have any explicit information about the mortgage broker payment. But it came to him later. It was a bit imprecise, to be honest. So no, I don't think people know. It's very interesting that mortgage brokers are an example of financial advice that is paid in ways that are an impingement on the borrower, but are not upfront payments. So we know that the substantial impact on financial planning that has occurred as the fee disclosure rules have changed. And it's interesting that we don't see the same impact on mortgage broking, where the fee disclosure rules are really not changed. And it does make you wonder whether, if the Hayne Commission the Hayne Inquiry recommendations had been implemented, whether we might have seen something similar happen to mortgage broking as we have seen happen to financial planning. Sonali asked, do financial advisors and consultants also have the same influence as brokers? So I haven't made a direct comparison, but there's a lot of characteristics that we find. We've done a fair bit of research on financial advice. There are some striking similarities between the way that financial advisors and mortgage brokers impact on clients. The levels of confidence that people express after they've engaged a broker are very similar to those that are expressed by financial advice clients after they've been dealing with a financial advisor. I think the power of a personal relationship is extremely strong in these settings. We also find that, similar to financial advisors, a lot of people go to brokers on word of mouth recommendation. So it tends to be the friends and family connection that leads to broker business. I don't have a lot of rigorous evidence, but my initial reaction to that question would be yes. And can you explain? Josh asks, how would you explain the impact of mortgage broker use intentions on the lump sum versus framing effect in the first paper? surely this can't be due to the self-interest of broker advice. So I wasn't very clear about that, Josh. So sorry, I've caused some of the confusion here. The difference in that table was about included people who had used a broker in the past and intended to use one in the future versus those who did not intend to use a broker in the future. So these are people who either had consulted a broker, that was the majority of the group, and there were also some people who intended to use a broker but had not yet used a broker. And I think the lump sum versus monthly framing effect is we do find is moderated by having consulted a broker in the past. Yeah. So I probably wasn't particularly clear about that. Sorry. Yeah. No problem.
What changes would you like to see as a result of your research?
Yeah, none yet. I don't think we've finished. I think there's a long way to go here. Look, it's not surprising, is it, that a piece of research like this should find that brokers serve a positive function in educating clients, and potentially they also tilt clients towards products that suit the broker. So that's what we would expect to see, not one or the other. I think it's pretty clear wherever this happens that, that there are two things that would probably help. One is I do think people need to understand the way that brokers are paid when they engage a broker, and that doesn't appear to be well done yet. And the other thing I think it's worth saying is that the structure of remuneration should be made in such a way that it means that broker and client incentives are aligned. And I don't think that that's happening yet either, because if brokers are paid in such a way that they get more money on the basis of volume and duration of a loan, that may be in the interests of some clients, and it's likely to be not in the interests of other clients. So we need a remuneration structure that's subtle enough and flexible enough to cater to the incentives of both the broker and the client, rather than, with the asymmetry of information in that relationship that potentially could be tilted towards brokers. What kind of nudges can we design to help borrowers borrow money more sensibly? We're doing some more work on this question in a slightly different but related project. And I think people do try to borrow sensibly. The impression that I get from reading responses to a lot of the things that we do in these surveys is that this is a decision that people take seriously, and they really do try and think about it. I do think that rather than nudges, I think that borrowing is probably a bit narrowly framed, and that possibly what we need is a broader discussion about the risks that are relevant when you're taking out a mortgage. Now, obviously, people are acutely aware of interest rate risk at the moment, but the next thing could be, if there were to be a recession, and I hope there isn't, but if there were to be a recession, then the strains on repayments through unemployment or periods of unemployment are also really significant, and not everybody thinks about that or understands what that risk is. So I guess the way that we're going is not so much nudges as thinking about ways to help people frame the mortgage choice broadly within the context of their household portfolio. With the current rise of interest rates and economic inflation, do you think renting is better than owning a mortgage property with a mortgage in general? This is I don't think I'm qualified to answer this question. Surely it depends.
We do not give financial advice in
we
these
do not give financial
guys.
advice, exactly. There are so many trade-offs in that decision, aren't there? Look, I really think it's great to ask the question, because I think, Abek, you're asking about a set of really complex trade-offs. There's so many risks involved, and that's why we're studying this question, because it's actually both incredibly important and incredibly hard. And people obviously turn to brokers for advice. And then, so we need the broker to give them advice, but also to give them good advice. And we seem to be in this grey space where there's some help and some hindrance. Maybe rather than thinking about the problem, like I said, I don't think thinking about the problem more simply is necessarily the answer, but maybe we could have simplification of products. So one of the other things that appears to be true is that some products are intentionally complex. You know, bundling all these banking products together and selling them as one package doesn't seem to me to be a practice that's really supporting robust decision-making by consumers. So we're into a discussion about home ownership. My experience with talking about home ownership in Australia is that if you want your phone line to ring hot and the trolls to engage with you on social media, then start talking about home ownership. It's such an emotional topic in Australia, as it is in many other parts of the world. So yeah, we may need to reframe the concept of ownership and have broader concepts. Josh is going back to asking a slightly difficult question, but this type of research appears to suggest brokers are breaching their fiduciary obligations. I don't know what their obligations are, but I don't think they're fiduciary. Someone in the room who's a better lawyer than I might know the answer to that question, but they're actually agents of lenders. So brokers act to market the loans of the lenders that are on their platform, and they're paid by the lenders. So there could well be people in the room who can give a better answer than I, but I don't think that I'm not sure exactly what the obligations are. Yeah. Oh, Jack says they're covered by NCCP. Can you tell us what NCCP is exactly, Jack, just for the room? National Credit Code. Okay. Yeah. Okay. Yeah, they're credit providers. Yeah. Thank you.
Well, before we throw ourselves into an entire discussion surrounding ethical and legal codes, which, I mean, if you have an interest in it, please explore that interest, but leave me out of it. Not my topic of expertise nor interest. But Susan, I want to say thank you so much. We just gone past 7, so a couple of people have already dropped off, but really appreciate you making the time. I find your work absolutely fascinating. I hope some of the suggestions and the questions in the chat gave you some new research directions, but I'm very, very keen to see where you take it next. And please do keep us posted, especially in this highly volatile climate for financial, but specifically mortgage decision making. Well, thank you so much for making the time.
Thank you so much. And yeah, great. Thanks for the excellent discussion and suggestions. Thank you very much. Yeah. Bye.
Well, guys, as always, this is a monthly one. Thanks for attending this one. Make sure to attend the next one. We'll post on our social media and through the meetup page when that one will be and what it will be about. And for now, have an absolutely lovely evening and have an absolutely lovely month, realistically.
Thank you.
Bye, everyone.
Thanks, everyone. Thanks, Susan.
Thank you.